For many Australians heading into retirement, gifting to family is one of the most meaningful goals they have. Helping the kids with a house deposit, covering school fees for the grandkids, giving support when it's needed most. But here's the catch. Without the right strategy, that same gift could come back to hurt your retirement, cost you age pension benefits, or even end up in the hands of someone you never intended. In this video, I'll break down the 3 biggest risks you need to know before gifting, and towards the end, I'll go over some smart steps you can take to protect yourself and your family. Hey, I'm Chris Strano, founder of superguy.com.au and managing partner at Toro Wealth, where our vision is to be Australia's most trusted retirement planning firm. If you're new here, hit subscribe for more retirement planning tips. And just a reminder, this video is general information only, not personal advice. Alright, let's dive into the 3 biggest risks of gifting money or assets, starting with number 1, tax implications. So a question I get all the time is, are gifts to family members taxed? Well, in Australia, there's no specific gift tax. To clarify, a gift is generally defined as a voluntary transfer of money or property where the giver expects nothing in return and receives no material benefit. Gifts made to family members aren't considered taxable income, so the recipient generally doesn't need to declare them to the ATO. That said, certain tax implications can arise depending on what you give. Gifting assets like shares or property can have capital gains tax or CGT consequences. If you give someone an asset for less than it's worth or for free, the ATO may treat it as if you've sold it at market value. That means that you as the giver might have to pay CGT on any increase in value since you bought it. For example, if you bought an investment property for $600,000 10 years ago and it's now valued at $1 million at the time you gift it, the ATO treats this as if you sold it at market value. That means you would have a capital gain of $400,000, $1 million minus $600,000. Because you've owned the property for more than 12 months, you may be eligible for the 50% CGT discount, reducing the taxable gain to $200,000. This discounted amount would then be added to your taxable income in that financial year, and the tax you pay depends on your marginal tax rate. The person receiving the asset doesn't have to pay any tax right away, but they may need to in the future. The asset's value on the day that you gifted it becomes their effective purchase price, which will be used to calculate CGT if they sell it or give it away at a later date. Now, if those assets are income generating, the recipient will obviously have to pay tax on any income the asset produces. For example, if you give shares, any of those dividends those shares generate in the future will count as taxable income for the recipient. And the same applies to investment properties. Any rent earned from the gifted property will need to be declared as income. Even gifting cash can create a tax obligation. If the recipient invests that money in, for example, a high interest savings account, the interest earned will also count as assessable income. But tax isn't the only hurdle. Centrelink also has strict rules around how much you can give away. So let's move on to risk number 2, Centrelink limits when gifting. And while there's no actual limit on gifting, Centrelink sets strict thresholds that you must follow. Exceeding these limits can affect your entitlements, such as the age pension. So what are the limits? Well, Centrelink allows you to gift up to $10,000 in one financial year or $30,000 over 5 financial years with no single year exceeding $10,000. So what exactly happens if you exceed the limit? Well, if you exceed these limits, Centrelink will treat the excess amount as an assessable asset known as a deprived asset, and also apply deeming rules and include the amount in your income test for age pension eligibility. These measures apply for 5 years from the date that you make the gift. Both your total assets and deemed income are used to assess your age pension eligibility and calculate your payment rate. By gifting over the allowed threshold, you could unintentionally disqualify yourself from receiving the age pension, or at the very least see your payments reduced. But in saying that, if you didn't gift the asset, it would generally be assessed anyway, so it's no real difference. Now, the third major risk, and one that often gets overlooked, is the legal risk that comes with gifting. So gifting money or assets to family can feel like a simple act of generosity, but gifts can carry unexpected legal risks. These risks don't typically affect you directly as the giver, but they can impact where your money ultimately ends up, potentially going against your original intentions. In the event of a divorce or separation, family law courts will assess gifts and inheritance based on factors like the timing of the inheritance, the nature of the relationship, and the intention of the giver. If your gift was used for something shared, such as a house deposit, it may be treated as joint property and included in the property pool for division during a separation. In other words, what you intended as help for your child could unintentionally benefit their ex-partner in the case of divorce or separation. If you're worried about how a gift might be used or want more peace of mind, you can reduce the risks. Here's how to make sure that your gift stays in the right hands. Firstly, having formal loan agreements. If you're giving money as a loan rather than a gift, having a formal loan agreement can help protect that money. In the event of a divorce or separation, money given under a properly documented loan may be recognised as a debt owed to you rather than counted as part of the couple's shared assets. This can give you a stronger chance of recovering these funds and bringing them back into your own family's pool of funds. The important thing to remember here, though, is that a loan is not a gift. Therefore, a loan by you to someone else will continue to be assessed by Centrelink as one of your assets indefinitely until the loan is repaid, whereas excess gifts cease to be assessed by Centrelink after 5 years. The other way you can protect assets is by creating legal structures. For larger transfers or when you want to retain more control, formal legal structures can help protect your gift from being lost in a divorce or misused. Options include setting up a trust or using a binding financial agreement, commonly known as a prenup or postnup. Again, these structures, like a loan, may continue to be assessed by Centrelink as an asset. There's no loophole to get around this. Such legal structures and agreements need to be handled carefully, so it's essential you seek legal advice before implementing any arrangement such as this. So let's pause for a minute. We've covered the 3 key risks when it comes to gifting: tax implications, Centrelink limits, and the legal risks. So here's the big question: should you gift an early inheritance? Well, more and more pre-retirees are doing exactly that, seeing gifts as a way to pass on their wealth sooner. And while early gifting can be a rewarding and practical choice, it comes with trade-offs to consider. Let's weigh them up. Firstly, the pros. Gifting early provides support when it's most needed. Your gift can help your children on the property ladder, cover education costs, or navigate major life events when they need it most. Additionally, you get to witness the benefits. Early gifting allows you to share in the joy and witness the positive impact your support makes. And lastly, you simplify your estate. Gifting during your lifetime can make estate planning simpler by reducing the size of your estate. It can also help manage family expectations and reduce the risk of future disputes. But it's not all upside. Here are the trade-offs you need to weigh up. With early gifting, you can impact your own financial security. So before deciding to give large sums, it's important to ensure that your own finances are secure. Without proper planning, you could unintentionally compromise your retirement lifestyle and ability to handle future unexpected costs like home renovations, medical bills, or aged care. Secondly, by gifting, you risk affecting your age pension eligibility. Under Centrelink rules, any gifts over the allowable limits are counted as part of your assessable assets for 5 years from the date of the gift. Excess amounts can reduce your age pension payments or disqualify you from receiving them altogether. And lastly, you could lose control of the asset. Once you've gifted an asset, you generally lose control over how it's used or who ultimately benefits from it. Before making any significant gifts, it's important to put your own finances first. Make sure you've planned for your retirement needs, both expected and unexpected. Look, if those downsides have you hesitating, there's another way to help without giving it all at once. Instead of gifting a large lump sum, you might choose to spread out your support through smaller offerings over time. And whether that's with helping the grandkids' school fees, paying for the occasional family holiday, or easing mortgage repayments, your ongoing support can provide timely relief, and you get to be there to see the impact that it makes. This approach can also help you stay within the Centrelink's gifting limits of $10,000 per year, capped at $30,000 over 5 years. Now, whichever way you choose to give, it's worth taking a few extra steps to protect yourself and your family. Let's run through 6 tips that will help you do it safely and smartly. Firstly, keep clear records of your gifts. Good documentation helps protect your intentions. It can be particularly important if your gift is subject to a legal dispute or Centrelink assessment. At a minimum, this means noting the amount, date, recipient, and the purpose of the gift. Involving a solicitor to document the gift may be a wise step, especially when dealing with large and more significant assets. Number 2, be clear. Is it a gift or a loan? Clear, written terms help protect your contribution and everyone involved. If you expect the money to be repaid, make sure the recipient understands this and formalize the arrangement with a loan agreement. Without proper documentation, what you intended as a loan could later be treated as a gift. Number 3, don't overlook superannuation death benefits. While not directly related to gifting, superannuation death benefits are another key consideration when it comes to family wealth transfers. A superannuation death benefit is a payment made from your super fund to your nominated beneficiaries after your death. The tax treatment of super death benefits depends on several factors, including who receives the benefit. For example, adult non-dependent children may pay tax on a death benefit, whereas spouses generally do not. Understanding how your death benefits will be treated can help ensure your broader estate planning is as tax effective as possible. Number 4, start early. Gifts made within 5 years of applying for the age pension will count towards Centrelink's income and assets tests. By starting earlier, you can avoid having those gifts impact your entitlements. Number 5, stay within Centrelink's limits. Centrelink allows you to gift up to $10,000 per financial year and a maximum of $30,000 over 5 years. By staying within these gifting limits or gifting-free areas, you help protect your age pension entitlements from unexpected reductions. Number 6, seek professional advice. Before making significant gifts, it's worth speaking with a financial advisor, accountant, or estate planning specialist solicitor. A financial advisor can help you structure gifts in a way that protects your age pension entitlements and avoids unintended legal or tax complications. They can also help ensure your gifting decisions support your broader financial plan and retirement goals. Whatever you do, seek advice before making the gift, not after. And that brings us to the main point I want you to remember about gifting. While gifting can offer significant benefits for your loved ones and estate planning, it's important to proceed with strategy and care. From Centrelink's gifting limits and tax implications to legal considerations around family law settlements, gifting must be done with careful attention to each of these areas. Before making significant or complex gifts, seek expert advice from financial, legal, and estate planning professionals. They can help you navigate these complexities, avoid unintended consequences, and make the most of your gifting objectives. At Toro Wealth, we've helped hundreds of Australians aged 50 to 70 retire with clarity and confidence. If you're ready to fine-tune your strategy, our advisors will help you personalize your plan and maximize your position. Book your initial consultation today at torowealth.com.au. If you've enjoyed the video, please give it a thumbs up and I'll see you on the next one.